So we basically started this part on estimating cost of capital for a project. And the basic approach here is we're using comparables, right? So the rationale here is you're thinking about estimating cost of capital for your new project, but your project is not a publicly traded firm. So it's actually pretty hard for you to get some data from your project. Then in this case, you could find some comparable firms, and ideally these comparable firms are in the same line of business as your project. Then you would calculate the cost of capital of that comparable firm or those comparable firms. And then you would use the cost of capital of these comparable firms as the cost of capital for your project. So this is the basic approach here, right? Of course, we have some details, and we also have to pay attention to how we actually do the calculation. Okay, we finished this part, that is all equity firm as comparables. So now let's think about a more realistic case. That is, let's say you have successfully found a comparable firm, but this comparable firm is not a all equity firm. Let's say this comparable firm is actually a levered firm. Here the word levered, right, basically means this firm has debt. So if the firm has debt, then this firm is a levered firm. In this case, a levered firm is obviously not a all equity firm. So the previous approach we have used does not apply to this case. So how do we estimate the project's cost of capital if we have a levered firm as a comparable? So here we will use what we have learned from the portfolio theory. So we will basically consider this firm. To be more specific, we will actually consider the firm's asset and consider it as a portfolio of a firm's debt and equity. Now, by doing this, then we would know that the return of the firm's asset would be equal the return of this portfolio. So basically, the beta of the firm's asset will match the beta of this portfolio. So let me use this nice picture to talk about this for a second time. So basically, you can see here of course, your goal is to estimate the cost of capital for your project, right? So it's about this guy here. And then you find out a comparable firm which is in the same line of business. So what you're thinking about is, in order to find out cost of capital for your project, you would find out cost of capital for this firm's asset, right? Now, how do you get the cost of capital for this firm's asset? Well, using this basic accounting formula, we understand asset equals debt plus equity, right? So this basically means the return on the asset is equivalent to the return on this portfolio of debt and equity, right? So in this case, we could calculate the cost of capital for this portfolio, right? This is a portfolio of debt and equity. And these three numbers should be the same. That's the basic idea here. In the end, you can see that to get our answer, the most crucial step is about how do you calculate the cost of capital for this portfolio of debt and equity. Now, let's talk about formula, right? Because these formulas will actually tell you how to do the calculation here. So let's first introduce some concepts, right? The unlevered cost of capital. The unlevered cost of capital refers to the cost of capital for the asset, right? So basically, we will use RU to refer to unlevered cost of capital. It is equivalent to the cost of capital for the firm's asset. That is, if we use RA to refer to the firm's asset cost of capital, right? Then we would have RU equals RA, right? So this is basically RA here. Right? This is RA. Now the question is, how do you find out RU? How do you find out the unlevered cost of capital, right? Because if you can find out RU or RA, remember these two guys are the same. They're just having different names, right? So if you find out the RA or RU, then you would be able to find out the cost of capital for your project, right? Now, this formula gives you the idea. How do you calculate the asset or unlevered cost of capital? The idea here is, well, we know that we could consider asset as a portfolio of debt and equity, right? So basically, we could use the portfolio weight on debt and portfolio weight on equity to get the portfolio return, right? So you can see that this portfolio contains two investments, equity and debt. And the portfolio weight of equity is given by this guy. And portfolio weight of debt is given by this guy. So basically, you can see that now we're going back to the first two lectures about how to calculate the portfolio returns. Right? So the return for this portfolio of debt and equity is given by this formula, right? And because asset equals debt plus equity, so the asset cost of capital is given by this formula. Okay. By the same sort of argument, we could also calculate beta. So here we're looking at asset beta or unlevered beta. So here unlevered beta equals the portfolio weight on equity times beta of equity. And the portfolio weight on debt times beta on debt. Okay. If we go back to this picture, so you can see that here for debt we have beta U. For equity we have beta E. So we want to find out what is the beta of the asset or the unlevered beta, right? So basically, from our previous lectures, we know that to calculate the beta of the asset or the unlevered beta, we would consider again the portfolio of debt and equity. So in this case, you would have this result. Right? Okay, let's look at this example here. So your firm is thinking about expanding its household products division. You identify P&G as a firm with comparable investments. Suppose PG's equity has a market cap of $144 billion and a beta of 0.57. And P&G also has $37 billion of debt outstanding with a AA credit rating and an average yield of 3.1%. Now the question is about estimate the beta of your firm's investment given a risk-free rate of 3% and a market risk premium of 5%. Okay, let me change the question into estimate the unlevered cost. That is, estimate RU of your firm's investment given a risk-free rate of 3% and a market risk premium of 5%. Okay, now how do you solve this? Well, first you should start from Capam, right? Why do you want to start from Capam? Well, because now you have risk-free rate and market risk premium. So all you need to do is to find out the unlevered beta. Then you could use Capam to find out the unlevered cost of capital. So RU equals RF plus beta U and market risk premium. Oh. Now, what is beta U? Well, we have just learned about this, right? Beta U is given by this formula. So let's use this formula to solve beta U. And we can find out the value of equity is 144. And the value of debt is 37. And beta of equity is 0.57. What is beta of debt? If you check the table, so we have a AA credit rating. So basically you should use this, right? It's a very small number. And if you check the textbook, the textbook assumes the beta is just 0. So I will follow the textbook. I'll put a 0 here. So this gives us a beta U of 0.543. And now let's plug in these numbers. 3% plus 453 times 5%. So this gives us 5.27. So this is basically the first method to calculate the unlevered cost of capital. The central point here is we use Capam, and in order to use Capam to find out the cost of capital, we have to use this calculation of unlevered beta, right? Okay, so let me remove my calculation here because obviously I have limited space. Okay, now let's think about the second method. Well, the second method obviously is about using this guy here, right? How do you use this formula to calculate unlevered cost of capital? Okay, great. So let me write this down. Oops. Clearly, we have the value of E and we have the value of D, right? So now we just need to find out what is our E and our D. And for the equity cost of capital, we can actually use Capam, right? Because our E equals our F plus beta of equity and market risk premium. Right? So it's 3% plus 0.57 times 5%. This gives us 5.85%. So let's plug in numbers here. 144, 44 plus 37, 7, oops. Now, what is our D? Well, we learned that we can actually get the cost of debt from yield, right? So basically, we have learned. Okay, I'm really running out of. Okay, our D equals yield minus P times L, right? That is the cost of debt equals yield minus the probability of default times loss rate. So here we don't have the numbers on probability of default and and loss rate, right? However, you can see that here we have an AA rated debt. So for AA rated debt, the probability of default is equivalent to 0, right? And the L loss rate is also very small. So we could just, for simplicity, we just assume this number is just 0, right? It's just a 0. So in this case, the cost of debt equals yield. Clearly, this is a special case, and it only holds for high rated debt, right? So if you have a CCC rated debt, then you have to make the adjustment carefully by plugging the probability of default and the loss rate if there is a default. Okay, great. So now we could just put 0 here. And this gives us 5.29, right? 5.29%. So basically, under these two methods, we have two slightly different numbers, right? Okay. Okay, now let's talk about a caveat when you're calculating the cost of capital. So basically, you can see that from the previous example, you can see that you will have to calculate the amount of debt, right? You have to calculate this guy here. You have to calculate D here. And the caveat here is if a firm has cash, then you cannot just use or input the amount of debt into these previous two calculations. Instead, you will have to use net debt, right? So basically, net debt equals debt minus cash. So here, you can see that intuitively, cash is like the opposite of debt, right? So it's like negative debt. That's why you would want to use minus sign here. And if you're using net debt, now the enterprise value, which is defined as E plus D, right? If you're using net debt, well, you have to exchange this D for ND, net debt. Okay, let's see this example here. At the end of December 2012, Apple had a market cap of $413 billion. It has no debt and $137 billion in cash. If we estimate the equity beta was 0.965, estimate the beta of Apple's underlying business enterprise. The wording here is kind of weird, right? So estimate the beta of this firm's underlying business enterprise. So this one asks about beta of the business. Well, this is really beta of A. That is beta of the firm's asset, or the unlevered beta. So here we could use the previous formula, that is beta A equals D divided D plus E RD plus D. Oh, sorry. Obviously, we should use E in the numerator. RE. Now, what you can see here is Apple has no debt. All right, so we could basically remove this term. And Apple has cash, so we should use net debt here. Right? Okay, now let's input these values. So the value of equity is 413, and net debt is given by 0 minus 137. Right? Again, net debt equals debt minus cash. That is obviously 0 here. And times its beta, which is 0.965. So this gives us 1.444. Okay, industry asset betas. So you can think about this. In reality, right? When you're thinking about estimating beta for a business, generally you could get multiple firms, right? For example, if you want to estimate the beta for operating a coffee shop, then the potentially comparable firms would be, let's say in Canada, you could use Tim Hortons, and then you have this Starbucks, right? So you basically have two firms. And in some industries, you could have more comparable firms. So in this case, you can see that if you have multiple firms, you can actually combine estimates of asset betas for those multiple firms, right? So you could use a average number, right? In this case, when you're using average, we know that averaging across different numbers can generally reduce the estimation error, right? So this implies that in the chance when you're having multiple comparable firms, using average industry asset betas would give you better estimate. Okay, now let's see this example here. So let's say we're thinking about okay, so we are looking at these the US department stores, and here we have 1, 2, 3, 4, 5, 6, 7. We have 7 firms, right? And you can see that here we want to look for the average and median asset beta for this industry. So what you can see here is we have equity beta and we have these portfolio weights, right? So D divided by V is essentially D divided by E plus D, right? And we have debt rating. So given debt rating, we could use the table to find out debt beta, right? And if you have D divided by E plus D, then you could calculate E divided by E plus D, right? Now let's calculate beta for this first firm, Dillard's, right? Okay, so to calculate the asset beta for Dillard's, clearly we need the following data points, right? So D divided by V times our, we're actually looking for beta here. So it's D divided by V times beta D plus E divided by V times beta E. Now, what is D divided by V? Well, 0.59. What is beta D? So we basically have to check the table here, right? So if that rating is B, we would use this number. So it's 0.26. Now, if the portfolio weight of debt divided by debt plus E equals 0.59, then E divided by debt plus equity should be 1 minus 0.59, right? So this should be 0.41. Now times beta of equity. Well, this is obviously given. So 2.38. Right? So this gives us a number of 1.13. Now clearly you could do the same for the other 6 firms. Right? So you will have asset beta for all these six firms given in this column, right? That is given in this column. And now you're thinking about using average. Well, everybody knows how to calculate the average, right? So you will basically get the sum of these 7 asset betas, and you will divide the sum by 7. Now, what about median, right? So median is really the guy in the middle, right? So who is the guy in the middle? This guy is actually in the middle, because if you look at 1.13, you could find out there are 3 firms having higher asset beta, right? So it's 1. Okay, let me rank these numbers. Then you will see why 1.13 is the median here. What's the next one? I think it's okay. I'll start from the smallest one. Right. So if you rank these asset betas from the highest to the lowest, you will see that 1.13 is in the middle, and by definition, right, median is just the number in the middle if you rank numbers. Okay. In reality, there are very large differences in terms of asset betas between different industries. So if you look at this picture, right, the vertical axis basically gives you asset beta, and the horizontal axis gives you different industries. So here you can see that tobacco, right, in January 2013 has the asset beta of about 0.55, right? But if you look at these, if you look at this guy, semiconductor equipment, right? So it's, I guess it's 1.55, right? So let's say this is 0.55. You can see that there is a very large difference. Essentially, the asset beta for the semiconductor sector is 3 times the beta of the tobacco sector, right? Why do you see this kind of difference? Well, you can think about their businesses, right? If you're in the tobacco business, then you can imagine that your business will actually stay relatively stable across different economic conditions, right? If the economy is great, smokers, they will maybe, let's say, smoke 3 cigarettes per day. And if the economy is not that great, well, because they're smokers, so I guess they still have to smoke. So let's say in this case, if economy is bad, they will average, right? On average, they will smoke 2.8 cigarettes per day. So we can see that your tobacco business is relatively stable irrespective of what the economic condition is. But if you look at the business operation of this semiconductor equipment industry, right? It's this, I guess it's the upper supply chain for high-tech industries. And we know that high-tech industries is a high beta business, so it's sensitive to economic conditions. Then in this case, you can see that this high-tech semiconductor industry will have high beta because its business is inherently volatile. Okay, now let's look at the final topic. So in this case, we want to think about financing, right? Sorry. So basically, when we were thinking about estimating the project cost of capital, we actually made this assumption that this project is unlevered, right? So we assume we would finance this project just with equity. Now, let's think about this more realistic case. Here we assume you could basically use both debt and equity to finance your project. You have this optional paragraph here, so it's not required. And then this one is also not required. So let's jump to the required part, right? The required part is about how using debt will affect a firm's cost of capital, right? To answer this question, we have to define a new concept, which is the weighted average cost of capital. First, let's start with the after-tax interest rate. So let's say the firm pays interest rate R on its debt, and the interest payments on debt are tax deductible. In this case, the after-tax interest rate is R times 1 minus corporate tax rate, right? Basically, this implies that if we consider corporate tax rate, the cost of debt will be lower, right? I won't talk too much on why the after-tax interest rate is calculated in this way, because in the future when we talk about capital structures, we will actually talk about this, right, in more details. So at this stage, let's just remember that to calculate the after-tax interest rate, you would use R times 1 minus corporate tax rate. Okay, after defining the after-tax interest rate, now we could calculate the weighted average cost of capital. Weighted average cost of capital measures a firm's after-tax cost of capital by factoring how the tax deductibility of interest payments will affect the cost of debt. So, weighted average cost of capital, which is also called WACC, right? So WACC is calculated as this. You can see that it's pretty similar to the calculation of unlevered cost of capital or asset cost of capital, right? The only difference is we will have to think about corporate tax, right? So basically, when your project is only financed by equity, then you should use unlevered cost of capital, right? And if your project is financed by both equity and debt, then in this case, you should use WACC. Okay, now let's see this example here. So the firm has a market cap of $100 million and $25 million in outstanding debt. Its equity cost of capital is 10%, and its debt cost of capital is 6%. The first question is, what is this firm's unlevered cost of capital? And the second question is, if its corporate tax rate is 40%, what is its WACC? Well, you can see that this one is actually very simple, right? It's just about directly plugging numbers into these two formulas, right? Okay, now let's first start from unlevered cost of capital. And we know the firm's debt is 25, right? Yeah, 125, and debt cost of capital is given by 6%, and this part is 100 divided by 125 times 10%. So this gives us 9.2%. 9.2%. Now the second question is about WACC, the weighted average cost of capital. In this case, this RD has to be adjusted, right? So basically, we have to consider the corporate tax rate. And because the corporate tax rate is 40%, so 1 minus 40% gives you 60%. And 60% times 6% debt cost of capital, then we get 3.6 after tax interest rate, right? So this gives us, oops, oh sorry, that's weird. Where is the, oh, it's here. So this gives us 8.72%. Of course, we're actually calculating WACC here. This one is like the simplest calculation in this chapter, right? Just plugging numbers. Okay, let's end this chapter with 3 questions. First, why does the yield of a firm's debt generally overstate its debt cost of capital? First, let me remind you that the cost of debt equals yield minus P times the loss rate. So judging from this formula, you would see that the cost of debt is smaller than yield. Now, the question is, why do we have this result? What is the intuition here? Or what is the economics explanation we can have here? Well, the reason is because yield is really the promised return if there is no default. And if there is default, as a bondholder, you will suffer. So your return will be smaller compared with the promised return. That is, if there is default risk, the cost of debt will be smaller compared with the yield. Second, describe 2 methods that can be used to estimate a firm's debt cost of capital. Well, we actually have talked about the first one, right? This is the first one. That is, you would adjust a firm's debt yield to get the cost of debt. The second, you will use Capam. And we also have talked about the caveat when you're applying Capam to find out the cost of debt. The caveat is you will not use the beta of debt, right? You won't use this. You will use the beta of the rating category, right? This is what you will use. So let's say you're trying to estimate the cost of debt for a BBB rated debt. You will not use the beta of that specific debt. Instead, you will use the beta of all the portfolio of BBB rated debts, or the BBB rated category, right? That is the beta you want to use. Third, how does the equity beta of a levered firm different from the beta of its asset? First, you could actually think about the formula, right? So you can see that the beta of its asset equals this guy here. Very obviously, this is sorry, I should not write down cost of debt and the cost of equity. I should use beta of debt and beta of equity. So clearly you can see that This is beta of equity, and this is the beta of the firm's assets. So obviously these two numbers are different. Or you could use this nice picture here, right? This is asset. This is liability, or this is debt. This is equity. So beta of equity refers to beta of this guy here. Beta of asset refers to this guy here. Well, obviously they are different, right? Okay, that's great. Now let's move on to the next chapter. Okay, so this chapter is called Other Models to Calculate the Cost of Capital. And you could also see that this is really just a part of chapter 13. Chapter 13 is actually a quite interesting chapter. But we have some limit on our time, so I will just pick some important topics from chapter 13. However, if you have time, I would recommend you to read this whole chapter because it's really fun, because it will talk about several different investment methodologies, and you will also learn about some behavior finance, so it's quite interesting. Okay, judging from the title, you can see that we will talk about other methods to calculate the cost of capital. So this is actually a fairly important chapter because our focus here is really about calculating the cost of capital, and we basically have only learned one method, right? Capam. That's like the only method we have learned. And now we could expand our views. We could expand our mind to understand more method, which is nice. Okay. Now, let's first consider why Capam makes sense, right? So let's first defend Capam, right? Now let's say we're looking at an example here. Let's say we have two stocks, right? Sunker and Barrick Gold. And now let's say due to something, right? Because something has happened. The textbook tells you that suppose some new information has arrived and the market price remains unchanged. And in this case, this piece of news will increase the expected return of the Sunker stock, and it will decrease the expected return of the Barrick Gold stock. So what happens is, in the beginning, right? In the beginning, both Sunker and Barrick Gold, they were on this security market line. I would also want to remind you that we have learned about this in the previous chapters. We learned if Capam is true, then all securities returns will stay on this security market line, right? Because all securities returns are dictated by Capam. And if you draw out Capam, it's just a line. So if Capam stays true, then all securities returns will stay exactly on the line. Now, let's say now something unthinkable has happened, right? You can see that this is kind of weird because now we're saying that because of this piece of new information, Sunker's return moves up, right? So now the return moves to this dot. That is, the return of Sunker goes above this security market line. This actually violates Capam, right? And now we could also look at the Barrick Gold. So in this case, Barrick Gold, its return will actually gets pulled down from the security market line. So it will stay below this security market line. Again, this violates Capam. And if you want to defend Capam, then you could see that this kind of deviation cannot stay for too long, right? This deviation will be corrected by market force. Let's see how this deviation can be corrected. Now, so basically if you, let's say we focus on this case, right? In this case, you can see that Sunker's stock's return is actually pretty high, right? It's higher than the return predicted by Capam. In this case, investors, they will actually buy Sunker, right? They will actually want to buy this Sunker stock because it has superior returns, right? Now think about this. If a lot of investors are trying to buy Sunker's stock, then it will push up today's price, right? So let me write down here. So what will happen here is a lot of investors, right? They would want to buy Sunker, right? Now, what will happen? Well, Sunker's price will get pushed up, right? Its price will increase. If Sunker's price increases, then Sunker's return will decrease, right? Why Sunker's return will decrease? Well, it's pretty simple because return equals tomorrow's price divided by today's price. If today a lot of investors are buying the Sunker energy, then you can see that its price will increase and this R will decrease, right? So that's why increasing today's price, you will have a lower return. Now, if you will have a lower return, this implies that the return of this stock will actually get pulled back to this line, right? So it will get pulled back to this line. You could claim the same for this Barrick Gold Corporation, right? You can see here that the statement here is, if you're looking at Barrick Gold, then you can see that it has terrible returns, right? So in this case, investors will want to sell Barrick Gold. And if a lot of investors are selling this stock, then this implies its price will be what? Reduced, right? The price will decrease. This implies its return will increase. So you can see that this Barrick Gold Corporation's stock will get pulled up, right? So in this case, again, the return of Barrick Gold will go back to this security market line. So what's the lesson here? It basically tells you that competition, right? Competition is a strong force to push all stocks back to this security market line. And we know that if the market is efficient, then Capam is correct, then all securities should stay on this security market line. So this basically implies that competition is a force to keep the market portfolio efficient, right? So that's basically how we defend why Capam is true, right? Let me restate, or let me summarize. So basically, the statement goes like this. Assume that there is some deviation happening, right? For example, this Sunker Energy's stock goes up and it deviates from this security market line, and the competition force will put down its return. So this deviation will actually disappear. Then market portfolio will actually stay efficient or go back to be efficient, and Capam will still hold. Okay, next let me talk about this related concept, that is alpha. Now, what is it, alpha? In this picture, alpha is given by this deviation here, right? So this is a alpha. To be more specific, it's a positive alpha. And this is also a alpha. It's a negative alpha because return is below the security market line. So by definition, alpha is the difference between expected return and its required return. What is the required return? Well, it's just the return given by Capam, right? So you can see that this guy here is the return given by Capam. This guy on the top is the return, is the expected return. So the difference here gives you alpha. Now, after introducing alpha, we could basically summarize the first section's result as follows. Competition is a strong force to remove any alpha from the market, right? So if Capam is correct, then we should not expect any alpha, right? Because think about this. If Capam is correct, if market portfolio is efficient, then all stocks should stay on this security market line. That is, all stocks' expected return should equal its required return predicted by Capam. So there should be no alphas, right? So this is actually an interesting argument. It basically means that if we wanted to examine whether market portfolio is efficient, whether Capam is true, we could examine whether we can get alphas from the market, right? I have to say this section is quite conceptual. And I would also say that the focus here is really not about how to calculate alpha. This is basically a sort of, I would say it's the first, it's sort of like introduction to this, to those additional models. Okay, now let's examine whether we can actually get alpha from the market. Right? Remember our goal here. We know that if market portfolio is efficient, Capam is correct, then there should not be any alphas. So if we can find positive alphas, then this basically tells us maybe market portfolio is not efficient. Maybe we should look for additional, potentially better models, right? Okay. Now let's see some empirical evidence. So we will basically look at several trading strategies and see whether these strategies will give us positive alphas. So the first one is the trading strategy based on size effect. This is actually a very famous result. The general result here is small market cap stocks have higher returns than the market portfolio. Or put it simply, you can get positive alphas from investing in small cap stocks. This is from a very famous paper from Fama and French. So what they did was very simple. they basically divide stocks each year into 10 portfolios, right? By ranking them based on their market cap. And then they will calculate the monthly excess returns of each portfolio over the following year. And then they will calculate the average excess returns of each portfolio and the beta of the portfolio. So basically the process is just like this. So you separate these stocks into different portfolios, right? Into 10 different portfolios. Right? Do we have 10 here? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Right? And then for the first portfolio, you have largest firms. Here size is measured by market cap. And then size of these firms will just become smaller. So here you have smallest firms. And then you will calculate return for this guy, return for this guy, return for this guy, right? And then you will also calculate beta for each portfolio, right? And after getting this return and beta, you could basically draw the return and beta on a picture, right? So this is what we got. So the vertical axis gives you the average monthly excess return. The horizontal gives you beta. Now what you can see here is this is the portfolio of the smallest stock, right? So you can see that the portfolio of smallest stocks gives you the highest alpha, right? And if you look at these portfolios, there are the portfolios of largest stocks. So you can see that these largest stocks portfolios, they either give you very small alpha or they will actually give you zero alpha, or worse, they will give you negative alpha, right? So you can see here, this one is sort of giving you negative alpha here, right? So this is the size effect. And this is, well, oh, by the way, how do you know you're having positive alpha? Again, we're looking at this line here, right? So if a portfolio is above this line, then you're having positive alpha. If it's below this line, then you're having negative alpha. And a related concept here is excess return. What is excess return? Excess return is the return of your portfolio minus the 1 month risk-free rate. Now, if you think about this conceptually, then you can see that this actually causes problems for Capam, right? Because according to Capam, we know that we should not get any positive alphas. But now we're actually getting positive alphas, right? Now let's see the second result. This result is about the value. Oh, this one is incorrect. It should call value effect. So this one is about calculating the stock's excess return and its book to market ratio. Now, first, let's define book to market ratio, right? So book to market ratio equals the book value of equity divided by market value of equity. How do you get the book value of equity? Well, the book value of equity is really the shareholders' equity, which is given by the balance sheet. Okay? How do you get the market value of equity? Well, it's really the price, the stock price. So it's really the stock price times number of stocks. Right? So this is how you calculate book to market ratio. Now, why do you want to calculate this ratio? Well, because you want to separate your stocks into two different categories: value stock and growth stock. What are value stocks? Value stocks are stocks with high book to market ratio. Right? So basically, if you have high BM ratio, then you will categorize this stock as a value stock. And if you have low BM ratio, then you would categorize this stock as a growth stock. Now think about this. Why high BM ratio stock should be called value stock? If you look at the formula here, look at how we calculated the BM ratio. You can see that the stock price is in the denominator. So it basically means that if a stock's BM ratio is high, then its stock price has to be low, right? So it has low stock price. On the opposite, if a stock has low BM ratio, then you would know that its stock price has to be high. So why a stock has high price? Well, the justification for high price would be, oh, this is a growth stock. It has great potential, right? So that's why low BM stock is considered high growth stock. Now, if a stock has high BM, then it has low price. So you would think, okay, this stock is cheap, so I could call it as value stock, right? Okay. Now, what's our finding here? Our finding here is value stocks have positive alphas, and growth stocks have lower or even negative alphas. If you look at this result here, you can see that again, this vertical axis gives us average monthly excess return, and we again have the beta on this horizontal axis. Now, what you see here is you can see that these blue dots are actually value stock portfolios. So you can see that these blue dots, they have the largest positive alpha, right? So again, this is a problematic finding because according to Capam, we should not find positive alpha. So this is basically the second evidence against Capam. Okay, let's end up this lecture with this example here. Let's consider two firms, SM Industries and Big Corporation, which are expected to pay dividends of $1 million per year. And SM's dividend stream is riskier than Big's, so its cost of capital is 14% per year. Big firm's cost of capital is 10%. Which firm has the higher market value? Which firm has higher expected return? Now let's assume both stocks have the same estimated beta, either because of estimation error or because the market portfolio is not efficient. Based on this beta, the Capam would assign an expected return of 12% to both stocks. How do the market values of the firms relate to their alphas? Okay, now let's just finish. Let's start with the first question. Which firm has higher market value? You can see that you can actually, you cannot actually direct compute market value, right? Generally, when you're thinking about market value, you would use stock price times number of shares. But here we don't have this data. So what you need here is you would use this equity valuation model, the so-called dividend discount model, right? So you can see that both firms would pay dividend of $1 million, and then their cost of capital is 14% and 10%. So 14% and 10% are just discount rates. So you can see that the market cap for SM is cash flow divided by cost of capital, which is 14%. And for big firm, it's 1 divided by 10%. So this one is about $7 million. This is about $10 million. So clearly, the big firm has higher market value. Which firm has the higher expected return? Well, you can see that for the small firm, its expected return is just the cost of capital, which is 14%. For big firm, it's 10%. Right? Now, let's say the two firms, they have the same beta, right? Maybe it's because some estimation error or because the market portfolio is not efficient. Now, if SM industries and big corporations have the same beta, then according to Capam, the required return should be the same for these two firms. Right? So let's use our Capam. So the return calculated by Capam, let's assume they are 12%. Now you can see that you could actually calculate alphas, right? Because for this first firm, this small industries, its alpha is the return or expected return minus the required return calculated by Capam. So its alpha is 2%. For this big corporation, its alpha is 10 minus 12%. So alpha is minus 2%. Now, what you can see here is, the answer here is sort of the same as the value effect we just learned about in this picture, right? You can see that small firm has positive 2% alpha, and big firm has negative 2% alpha, right? So it kind of fits into the narrative we have learned from the value effect. Okay, that's for today's class.